As soon as
Mhm.
you don't keep up with rents, you're getting crushed from the expenses going up, and you're going to start looking at developer offers for the land. And now you see these communities getting redeveloped. They're pretty much all communities that have just been let go. And this is exactly why. If the owner would have continued to raise rents with, inflation, and they would have been maintaining the property properly, they would have been doing great. They would have never considered a developer offer because the cash flow value would have been significantly higher.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted
Hey
Patel.
everyone, this is your host Ted Patel, and welcome to this week's edition of Decoding Cashflow Podcast. Today I'm excited to sit down with Mario Dattilo, a seasoned real estate investor and entrepreneur with a wealth of experience in mobile home park investing. As a founder of Equity Growth, Mario has built a strong portfolio in the niche of manufactured housing community, helping investors generate passive income and long-term wealth. So with that said, Mario, welcome to Decoding Cash Flow. It's a pleasure having you here.
Thank you, Ted. Appreciate the invite. Excited to be on here. I'm looking forward to talking shop with you.
Yep, sure. Yeah, it's going to be an exciting show. We'll go through all the nitty-gritties, your journey, your strategies, and how did you scale your mobile home park business, everything. So before we dive deep into the niche, right, if you can give our listeners a little bit background about yourself,
Yeah,
how did you get
yeah.
started into real estate? And before that, what did you do?
So I didn't do a whole lot before real estate because I was pretty young. I actually started my first business while I was in high school. I was 18 years old, started a marketing business with some friends. We had a contracted client that basically we resold long distance phone service, internet, cell phone service, things like that, and did pretty well. I was in my senior year of high school. And then a couple of years after that, they filed bankruptcy, the
Okay.
uh, the contracted client, and they basically put us out of business and had to go start all over again. And it's, I would say that if you are going to fail financially, fail early. Got
Yeah, you have a
tons
lot
of
of time to
runway.
recover after that. So,
Exactly. So I went from thinking I could retire in a few years in my 20s to thinking, oh crap, I have to start all over. And by the way, I have to dig myself out of this hole. So it was kind of a big paradigm shift. And it was great. I mean, I hated it at the time, but I look back now and I say it's really shaped the way I invest. It's shaped the way I do business, the way I communicate. It's definitely crushed my ego a lot. So I'm much more humble. And, after that, my partner and I started looking for another business to get into because I hadn't went to college and never did go to college. And so I had to really start another business. And so we got into the mortgage business. This is, call it 2005. So everybody's in the mortgage business at that time. And we realized all these clients are coming to us saying, what agent should I use to go find a property? So I went to my partner and said, look, I think we should really start a real estate company. I'll head that business up. And I didn't have a real estate license, had, some small real estate investing, wholesaling, things like that I'd done, but on a very small scale, like a handful, right? So I knew enough to be dangerous, but we agreed, let's start the real estate brokerage. And I was the managing partner of that. So I had to get my real estate license and partner with an old timer broker that really wasn't using his license. And, we built that business for a few years. And then 2008 hit, which we all know what happened there. And I was helping investors buy and sell houses, which was great because it kind of exposed me to higher volume single family house flipping. And I went to my dad, who had been in construction his whole life. And I said, you're a custom home builder. You did all this construction stuff, commercial and residential. Why don't we partner? I'll go find the deals. I'll manage everything. I'll turn around and sell them. You just handle the construction aspect of it. And that's what we did. So he said, yeah, let's go for it. And I ended up closing down the brokerage with my other partner and flipped houses from about 2008 to 2012, 13 ish. And then the market got boring because there wasn't anything distressed in the market anymore. And we said, let's just get into something that's more cash flow and a little bit larger. And so we first started looking at apartments because that just is an easy transition from single families, right?
Yeah.
And I was struggling to find good deals at that point because I was really going about it's funny. I went from this single family house flipping business, and we bought non-performing loans and all kinds of other stuff too, but it was generally, a business, right?
Mm.
Trading business. To then when I go to buy apartment buildings, I all of a sudden switch hats and I decide that I'm going to be an investor, right? And I completely failed because I had the completely wrong mindset about how to get into, a buy and hold property type. So somebody brings me this mobile home park. He was a commercial banker friend of mine, and he goes, "Hey, they're about to foreclose on this park. You could buy the note," which I'd bought before in the single family space. He goes, "Man, I think you could get a really good deal on this." And I wasn't familiar with mobile home parks, but I was able to kind of bridge the gap enough to understand how it would work, understanding apartments, and bought that deal and call it 2013. So that was kind of what launched me into this space. And once I realized how big of an opportunity that property type was, I just ran with it. I bought some storage, self storage. I bought some light industrial, and I've also bought
Mhm.
RV parks, but by far focused on mobile home parks.
All right. So it was like by accident you landed that deal, right? Someone just you
Yes,
weren't looking for the
thankfully.
mobile home park, but it landed in your lap, and that's how you got
Yeah.
started. Yeah.
Yeah. And I
Sometimes
was,
these things, right? They just come to you when you least expect.
yes, it was
Yeah.
perfect. It was perfect timing.
Yeah.
And one thing I'll note is that somewhere around that time, I started to realize that putting on this kind of passive investor mindset while trying to be an active investor was not the route to go. So I kind of switched
Yeah.
up and built out a real estate investing business like I had with the single family. And going from that mindset shift, I was able to take that mobile home park strategy and scale it.
Yeah. And when you're an operator, right? When you are the general partner or operator, you cannot call yourself as a passive investor. You're always
No,
active. Only the
no.
passive investor is the one who invest, sit back, relax, enjoy the freedom. That's
Yeah, and I think a
yeah,
lot of times, I think a lot of people make that same exact mistake. They basically, they think that when they go from the house flipping and wholesaling side, they go into the, cash flowing side and they try and think like an investor. They think they're going to find deals on LoopNet and Crexy and all these different websites, and then they're just going to hire a property management company and they're going to manage it for you. You're just going to get reports every month and it's going to just
yeah,
work for you. They wear too much of that passive mindset and don't realize it's the complete opposite. You're going to be operating a commercial real estate investment business,
yeah.
um, unless you're partnering with someone who is handling the active side and you're a true limited partner.
That's true. There's a lot of things that goes behind the scene, right? So
A
you got
lot.
to be ready for that. Yeah.
Yes, that's
All right.
absolutely true.
So tell us about your this first acquisition, right? The first mobile home park. Where was it? How much did you buy it for? How did you
Yeah.
manage the finance and so on? Just give a gist of it.
Yeah, so I bought this deal in my backyard. It was awesome because it was, I live in Naples, Florida, and it happened to be in Naples, Florida, a couple parcels away from the county courthouse. So just a prime location. An interesting thing about this is multiple people were trying to buy this as a short sale because, um, the owner was distressed. He had bought the property for redevelopment. He owed 4.2 million dollars or something on it, and the market fell out and he was stuck with this mobile home park that he never really intended to own. He was planning on scraping it and going vertical. And so all these people were trying to buy this property going in the front door from the seller as a short sale. Problem is, they'd get into it and they'd figured out that there was $1 million+ worth of code enforcement violations on the
Ah,
property that they couldn't get past. So by me going in the back door and buying the debt and foreclosing out on it, I was able to wipe out those liens. Now, kind of, if I'll get technical here, we ended up working out a deal with the county. I brought in a consultant that had worked on the construction aspects for the county, and said, let's do a sit down with them.
Hmm.
And we worked out a deal where if we cleaned up the property and met these certain requirements, they were just going to leave us alone and they weren't going to just start going after those violations again. And so we were able to, in our due diligence process and in our due diligence timelines, we were able to go paper a deal with the county. And then we closed on the purchase of the note. We bought that note for, I think it was 750,000, 725,000, something, 750,000.
What was
And
the
then
full mortgage?
say that again.
What was the mortgage, the full amount?
Over 4 million.
Oh, wow.
Yeah.
That was good.
So then we just went to the county and said, look, we're going to wipe out all your liens and we're going to start fresh. So do you want to be battling us? Because we're not like the other guy. We're not just going to sit back and take it.
Mhm.
We intend to fully, we fully intend to improve this property. So let's work together so that, it's a win-win for everybody and you leave us alone and the area looks better. But we
And
ended up,
when
go ahead,
when
what?
you when you went for the foreclosure, weren't there any other bidders who bid on the property?
No.
No?
No, because they would have, no, there was no other bidders on the loan because they would have had to have bid up to the loan balance for the bank or for us to walk away.
Yeah,
We could basically, even though
the
we didn't,
judgment amount was $4 million.
yes,
That's what it was. All right.
even though we weren't owed $4 million or our basis wasn't 4 million, the
Mhm.
note amount which we
Was
stepped into and was owed to us was 4 million. So we could have bid all the way to 4 million or halfway up and taken a check and walked off, right? So because we owned the debt then.
yeah.
So yeah, it was a really sweet position to be in. So we foreclosed and then we went to the borrower and we said, hey, you owe us 4.2 million bucks. Like this is not going to be fun. We're going to hold you to it, but we're friendly. We'll work with you. And he ended up writing us, $130,000 worth of, maybe it was yeah, it was about $130,000 over three checks over, call it 9 months. So we reduced our basis down into the 600s. We
Mm.
went in and we made improvements to the property. We brought in homes. There's only called three vacant lots that we filled. We paved the property. We built some additional parking area, just cleaned it up, built some wall up in front, did landscaping and new signage, all that kind of stuff. Just made a really nicer looking property. It was still,
Mhm.
an older mobile home park, but we cash flowed that property for about 5 years. Actually, after 16 months or so, we refinanced that property, returned all of our investor capital, which was only, I mean, we only had 150,000 into it. So it wasn't very much. We just refinanced right up to what we had into it, returned our capital. So it was all bank money. We refinanced that with a life company, non-recourse, and then held it for 5 years. And we ultimately sold it for $6.5 million. So it was a pretty sweet exit on that one.
Nice.
Yeah. So a 10x,
Yep.
10x sale, not 10x
Yeah,
return,
that
but
that that was
10x
a good deal.
sale.
Yeah, of course.
Yes.
So right now, do you focus just in Florida, or you look into the other states also?
We're buying across the country. We own in 6 states right now. We're offering on some communities in additional states as we speak. So,
Mhm.
I mean, I would say we're relatively agnostic when it comes to markets, other than we're not going into the super liberal states. Like we're not buying in California, we're not buying in Washington, we're not buying in New Jersey, we're not buying in Illinois. We won't do business where government doesn't want business to happen. So we just
Yeah.
avoid those states. Other than that, we're pretty much all over the country. And some of the states
And
are
just
probably
focused on mobile
purple.
home parks and few, I think you mentioned self-storage also, right?
Yeah, so we own self-storage in Florida and Georgia. We own RV parks in
Mhm.
Florida and Georgia, and we also own some small bay light industrial across Florida
All
as
right.
well.
All right. So tell us something about the acquisition strategies that you implement for acquiring this property. Where do you source it from, and how, um, you know,
Yeah.
after that, what are the main underwriting criterias that you use, rule of
Well,
thumbs, etc. Yeah.
I'm going to jump back to what I was saying before. When I first got into commercial real estate, I was just looking on LoopNet, Crexy. Everybody was telling me
Hmm.
to network with brokers and try and get pocket listings, and that's trash. Like, you're never going to buy good deals that way. And if you do, it's not scalable. So early on, thankfully, between the apartments and the mobile home parks, I kind of figured out, wait a minute, this isn't an investment business strategy. This is just trying to be a passive investor. I need to go build out a business around this, which was really focused on direct to owner marketing, which means
Mhm.
that we are mailing, cold calling. We do have a YouTube channel that drives some business as well. And we have a couple of referral systems that generate leads for us as well of off-market direct-to-owner deals. So I've never actually bought a park from a mobile home park broker in 12
Yeah.
years. It's
Wow.
just been all direct-to-owner deals. And, creatively, obviously notes um, we've bought parks subject to the existing mortgages. I mean, we've done a lot of creative deals, a lot of seller
Mhm.
financing on storage and the industrial and RV parks too. I mean, everything that we buy, we utilize just more of a creative deal sourcing strategy. But
Mhm.
yeah, it's all
And
dealing directly with the decision maker.
okay. So we're talking about the direct marketing, right? Any specific criteria you use, any websites or any database that you source all this information from? And how do you filter out, okay, these sims look to be the right people who might sell to us?
We we used to do kind of a sniper approach, I call it, where we would pick a market and then we would just farm that market very heavily.
Hmm.
We're typically targeting for, if you want to talk mobile home parks, 50 or more occupied lots. So we're trying to buy, more institutional quality assets that we have, a good buyer on the back end for and, good debt options for as well. But generally speaking, we used to just pick a market and farm it. And then after we started implementing more social media, YouTube, and my education company, we started getting leads from kind of all over the country, which
Hmm.
then caused us to go a little bit broader. And we said, let's do more of a shotgun approach, I call it, which means we're literally dialing, cold calling most markets. I mean, we have a team of 7 that are working the phones every single day, calling almost every park. We typically try and not pursue properties that have less than 25 to 30 occupied lots. And on those smaller deals under 50, we're usually wholesaling those. I also own a brokerage, but we want to monetize those leads, and then the larger stuff we buy ourselves. And I would say that we want public utilities, but we own private utilities as well. We want to be in, somewhat populated areas. We're not buying out in rural America in the middle of nowhere. Like there's got to be a reason for people to live there.
Yeah.
So 50,000 plus population is probably the lowest we go. We've done a couple that were slightly smaller, but that was because they were close to another major market. But public utilities being near some sort of population. We obviously want good job diversification. We want not just multiple employers, but also multiple industries. We want median household income well over $100,000. I'm sorry, median household income over $40,000. That's kind of the very, very bottom we would go, and then median home value of minimum of 100,000 for the median value. So we're kind of looking at high level macroeconomic numbers, and then we're kind of diving down into the zip code data, like what I just said with the income and home value numbers.
So now, I know you have been involved in manufacturing, housing also, right? This mobile home parks. Is
So
that right?
we are not in the manufactured. We don't manufacture manufactured homes.
Uh-huh.
We're dealers, so we'll buy the homes directly
Okay.
from the manufacturer, bring them in, set them up, and then sell them. But
Okay.
in our inside of our communities, but we do not do any sort of manufacturing of homes.
So how does this work? Like, if I understand it right, you buy this mobile home park, you have the lots, right? The pads.
Yeah.
You rent the pads. They can bring either their own home or they buy it from you. Is that right?
Yeah, think of it like this. We're kind of like a for-profit homeowners association. We own the land, the
Hmm.
infrastructure, the common areas, and the amenities. The residents
Yeah.
own their homes. What you just described when you said someone could bring their own home in, that would be like an organic move-in, we call that. It's pretty rare. typically we are bringing the homes in and setting them up. Think of it kind of like a builder, or
Hmm.
a builder and a house flipping company, right? So we'll bring in a home, set it up, and then we'll sell it like a builder would. But also sometimes we get um, homes back through eviction, which means that we end up getting that home back, we rehab it and sell it kind of like a house flipping company. And that's the function of the dealership. The dealership kind of functions more like a builder
Hmm.
house flipping company, where the community is more of a, like in a homeowners association. We approve people to move in, they pay us lot rent, but we do not typically get involved in the owner to owner purchase and, sale and purchase. They just find a buyer, they bring it to us to be approved. We don't miss any lot rent, we don't touch the home. It's just they're out, the next one's in. So we have very little um, turnover costs. We have very little make ready and downtime. I mean, we don't
Hmm.
miss rent in that scenario. So we don't
Yeah.
have any vacancy from that.
Yeah, it's difficult for people to move their homes out of the lot, right? Just to move from one lot to other, it's very difficult. And it takes a lot.
Yeah,
It's
it's very
expensive.
expensive.
Yeah.
Yes, it's very expensive. To set up a home in, call it Florida, 16, 17,000. Up north, it's even more. You're probably closer to 20, 21. But that doesn't include transportation and that doesn't include takedown. So if you had to take down a home, you might spend $3,000. Then you got to move it, which is probably another 3 to 5,000. And then you got another 15, 16 on the low end. So you're in the 20s to move it and set up a home. It's very
Yeah.
expensive. So
Yeah.
yes, they are mobile homes, but they're not very mobile. Most
And
people
normally,
never
what's
move
what's
them.
the average cost for these homes when you buy it new from the manufacturer?
Yeah, I mean, typically the retail buyer is going to be paying somewhere in the mid to high 60s into the 80s for a brand new home set up and ready to go with bank financing. Hmm.
Yeah.
So very affordable when you think about it, because it's pretty rare to be able to buy a home for under $100,000 and own it. Their payments are typically around the same or even less than a two-bedroom apartment. So it's very competitive, and their down payment is typically around 10%. So if you're buying a $70,000 home, they're putting 10% down, and they're all in payments with lot rent and a mortgage, is going to be somewhere around 1,400 or something. It's very, very
Hmm.
affordable to own that, and you're paying down the principal on it. You control it. You don't have anybody, with shared walls. You can park right in front of your home. It's very convenient, and we've just seen a lot of people coming from the apartment space to want to own their own homes, and this is the most affordable home ownership option there is.
That's great. And normally the rents, the in the current market, the rent increase typical to the multifamilies, 2 to 3%, 5% on an average. Of course, the COVID time was different, but how,
Yeah.
yeah, how does it go
Yeah,
with
3 to 5% I would say is
yeah.
pretty standard. What you'll notice is that most mobile home parks are pretty far behind. A lot of these owners have owned these communities for a very long time, and they did not raise rents. There was this secret little deal between the tenant and the landlord said, "Hey, I'm not going to fix anything, but don't worry, I'm not going to raise your rent." And the tenant goes, "Awesome." Right? And so the quality of the properties have really went down. And so have the tenants, because the quality of the properties went down, but the rents have stayed low. So we'll come in, we'll make the improvements, make the property nice again, and then we'll incrementally bring rents back to market, which then brings the value back up to what it should ultimately be. And then, yes, once it's stabilized, you're typically at 3 to 5% increases per year is kind of what we've seen over the last
And the
12, 13
improvement that you
years.
make, it's because the tenant, right? Actually, they own the structure of their home. So you don't do
Yes.
any improvement on that structure. It's just the outside, the common maintenance area, everything that you improve. Is that right?
Yeah, the big ticket items are going to be like roads. These owners a lot of times have just
Yeah.
let the roads go. And I mean, I drove through one in Texas recently as I was checking out a comparable property to one that we're closing on soon. And we're driving through this community. It's in Houston, and I'm literally having to go around and like drive into the grass because the potholes were so deep that we would have bottomed out this car. We were in an SUV, not a big one, but a small one, but still, it was so bad. So yeah, we have to often redo the entire roads. We mailboxes, the clusters, the signage, the install new lighting. A lot of times the fences are rough, so we got to refence the property. And also keep in mind, we, they may have a small clubhouse or an office or something like that, but we're also enforcing rules, excuse me, that haven't been enforced for a long time. So we're going to these tenants and saying, hey, clean up your crap. You got trash all over your yard. You need to paint your home. You need to take care of your home. So we're not going to go and do the work on their homes, but we're going to enforce the rules that are in place to push them to fix up their homes, which then ultimately beautifies the community. And, sometimes people don't like that. And they say, you know what, I'm used to living in, slummy conditions. I don't like these rules. And we say, okay, you should sell your home. And they
Right.
do. And then they move to someplace that'll allow that. We bring in better tenants. We set their expectation of, hey, look, we're in the process of cleaning this property up. You're going to be held accountable to the rules, and you need to fix this house up in order to buy it. And they do, because they're obviously they're attracted by the fact that it's an up and coming neighborhood. So, what's interesting is that people don't like mobile home parks in many cases, but it's a hidden gem when it comes to affordable housing. And these communities have really went downhill and have a bad reputation because of what I just explained. The owner owns it free and clear. It's a lifestyle
Yeah.
business for them. They're not putting any attention on it, and so it's went downhill. And they look at, a lot of times, us as the professional investors coming in. And when I say they, I mean the press or whatever. People will say, oh, they're coming in and they're raising the rents and they're making it, they're taking advantage of people. Well, not really. We're beautifying a property that's been let go, and you're okay with these people living in slummy conditions. We're not. We're going to make this a nice place to live again. And yes, we have to bring it to market to be able to afford all the improvements, but it should have been, the rents should have been up a long time ago, and the property should have just stayed maintained, which it didn't.
And now, have you ever felt that there is a conflict of interest when you raise the rent because they own the structure, right? When you raise the rent, does that put a pressure on them saying like, okay, now I'm either pressured to, pay the new rent or sell the property?
Sure. Yeah. Is it a conflict of interest? No, because they rent our land. They don't own our land. They rent
Right.
our land. They own their home. The truth is, the property taxes, the insurance, and everything to do with that property has went up many, many times
Hmm.
before they ever had a rent increase. So what's been happening is the owner's been getting crushed. That's why they're not taking care of it, right? Because
Hmm.
they can't afford to, because they're not raising the rents. So by artificially keeping the rents low, they're ultimately positioning themselves to be homeless. And what I mean by that is, sounds crazy, but think about it. You're a park owner. You're not making any money. The land value is now worth more than the cash flow value. And so what do you decide to do? You decide to
Just
sell
let
it
it
to a
sit. Yeah.
developer who's going to scrape it and put a high rise on it. So by keeping rents to market, I would argue that it protects the residents and allows them to keep their home in a community, because the valuation of the property and the cash flow of the property matches, the use of the property. As soon as
Hmm.
you don't keep up with rents, you're getting crushed from the expenses going up, and you're going to start looking at developer offers for the land. And now you see these communities getting redeveloped. They're pretty much all communities that have just been let go. And this is exactly why. If the owner would have continued to raise rents with, inflation, and they would have been maintaining the property properly, they would have been doing great. They would have never considered a developer offer, because the cash flow value would have been significantly higher to keep
Yeah,
operating
that's
as a
true.
mobile home park. Yeah, it pretty much, by not keeping rents to market, you put yourself in a position where there's a higher and better use for that land. So
I
we're
see.
actually saving communities and revitalizing them at the same time.
Okay. All right. And when you underwrite this property, what is the cash and cash return IRR that you're looking for?
Yeah, I mean, we're typically targeting deals that we can get our investor a 7, 8% cash on cash return year
Mm,
one. Our pref is typically 7%, so we want to hit or exceed that pref in year one stabilized. We want to be at a 10% cap rate or higher. Once we're
okay.
stabilized, we're buying properties that, we can typically stabilize in 1 to 2 years. Uh, we are targeting, mid to high teens for our investors for the IRR, 2x multiples.
Mhm.
And that's kind of where we target for our investors' returns.
And and what are the average cap rates right now in the current market?
Yeah, it's kind of funny whenever somebody says, what do parks sell for on a cap rate basis? Typically say it doesn't matter to me because
Okay.
I'm not buying anything on market. I'm you know, really the stabilized resale is where cap rate's really gonna matter to us. I mean, we're buying deals that sometimes are just break even and are
Mhm.
relatively low cap rate, but that's because there's significant, upside on the property
Improvements,
that,
yeah.
yeah, that we need to realize through our value add strategies. But I would say it depends. Market specific, you're anywhere from like 5 caps in crazy markets out to rural, 9 caps. So I think,
Mhm.
and that's unstabilized properties. I would say that, you know, um, I don't pay close attention to them, to be honest.
All right.
Yeah.
So now, and the financing is all non-recourse, of course, and similar to the other commercial properties, right? There's nothing out
We
of blue.
we typically will buy with local bank financing or
Mhm.
seller financing going in.
Okay.
And then once the property's stabilized, and those are recourse, well, not the seller financing, but the bank financing is recourse. We'll stabilize the property and then we'll refinance into a long-term non-recourse loan, agency, life company, CMBS,
Okay.
things like that, just like you would in apartments. Yep.
Okay. Great. Okay. Now, coming back to investors' relationship, right? As you mentioned, you have a lot of investors. How did you build? Tell us something about the strategies that you implement to build your investors database, to, nurture them. What do you do? And uh, just get some more inflow.
Yeah. In the beginning, for about 9 years, I had 5 investors, very scalable investors. It was usually one investor in a deal, they'd stroke the whole check. And
Hmm.
mostly high net worth. And we had one family office that invested a lot with us. But overall, that was my strategy, is to have the least amount of investors possible because, as you know,
Yeah.
the real estate business is very different than the finance and capital raising business. And private equities, it's a totally separate business. And so about 2 years ago, we changed that up a little bit. I started doing some co-GP deals where I had other partners. And that required me to kind of prove myself on that strategy, that the partners that I had before kind of like, hey, I don't know about this. This seems risky. Prove it. So I had to go out and kind of start fresh and work a new data, work my database, my friends, family, everybody I knew, over that, call it 9 year period, every single time someone said, do you need money? I'd say no, because I just really didn't need any additional investors. And but every single time I wrote their name in a spreadsheet. So I kept track of every person who ever inquired about investing with me. So I had like 120 people on a list to call when it came time to start raising that money from more retail investors. And now after we've proven that, strategy with the co-GPs and everything, of course our other investors are backing on these deals and everything. So now we've just kind of taken the approach of, we'd like to work with larger scalable investors that we can do a lot of deals with, to minimize the number of investors in each deal, but we still bring in retail investors regularly. We do, webinars. We do quite a bit of social media content. I have a podcast. We do, my director of investor relations, Daniel, he's my partner. He's networking like crazy constantly. And, we get a fair amount of leads coming in from my YouTube channel and from my
Mhm.
education company too, that kind of flow over to the passive equity side because they come in the door and they say, hey, I want to buy one of these. And then they realize all that's involved in it. And they're like, yeah, I got some money. Why don't I just participate in your deal? Looks like
Yeah.
a lot of work. You know what I mean? So um, I would say that our strategy to build our investor database has been mostly around education and social media content. Yeah.
Yeah. As you mentioned, right? The new investors, they want to get active, like they want to buy the deals on their own, but
Yes.
after looking at what goes behind it, they just say, "All right, let me participate passively first. Let me learn the learn the game before I I jump full-fledged into
Yes.
this." Yeah.
Well, and if you think about it, why do most people get into real estate? What is the one thing they say? I want to get into real estate for passive income.
Yep.
But they forget that there's no such thing as passive income in real estate. Real estate is an operational investment. It's a business, right?
Yeah.
Now you can take a passive position with an active partner, but somebody's got to be active because there is no passive, right? So
That's true.
I would even on, I would argue even on triple net type deals, there's still asset management related activities that are involved. Yes, you don't have much from a property management standpoint, but you have ownership responsibilities,
Yeah.
you have business plans, you have, when you have to change your tenants, you got leasing. So there is still an operational aspect to all real estate. And you just have to realize that going in.
That's true.
Or you
That's
should be
very true.
partnering with an experienced person that does it day in and day out, you know.
And I would say if you want to get into any of the business, right, any of the real estate business, whether it is a mobile home park, new constructions,
Mhm.
multifamily, just if you want to get a feel of that business, just start participating passively into it. See
Yeah.
how you feel, what do you think about it, and then get into active side of it.
Yeah, I'd say most people get into it. They see the reports, they see the returns. They're like, okay, this is fun. I get to participate in the deal. I get to,
Yeah,
ride the roller coaster from afar where,
yeah,
and then I haven't had too many people come in from the passive and then go to the active. They occasionally will ask about it, but it's usually the other way. People come in saying they want to actively do it, and then they go, it just looks like a lot more work. I'm retired
yeah,
and I thought this would be fun, but now I realize it's just another job,
yeah.
basically.
That's true.
um,
That's true.
yep.
Yep. All right. So Mario, before we started recording the podcast, you also mentioned, you have uh, the educational aspect also, right? You have a company where
Yeah.
you teach how to invest in real estate. So tell us something about that company. What are the things? Just a summary on what do you teach?
Yeah. It's called Real Cash Flow. And
Hmm.
I've always enjoyed teaching. Back to my first business, I recruited a lot of salespeople and trained them. And I really enjoy helping people and educating. And I had a lot of people hitting me up from Instagram and YouTube and all these places saying, "Hey, got this deal. Will you look at it?" And truth was is I didn't have the time because I'm busy running a business, right? And then when I did have the time and I made the time for them, they would basically waste my time, right? They weren't serious. They weren't as serious and committed to it. So I'd spend an hour going through what they should be doing from scratch, and then I'd hear from them 6 months later, like, "Oh yeah, I didn't have time to go out." I'm like, "You burned an hour of my life," like I'll never get that back. And so what I realized was that if I was going to continue to help people, then I needed to create some structure around it. And I needed to make sure people were committed because I don't have time to waste and I don't want to waste their time either. Right. So,
Yeah,
by creating this education company, I could justify spending a specific time every single week where they could rely on me and they knew that I was there to support them. And at the same time, I could create kind of a course as well that would give them a really strong foundation on the industry, the strategies, everything that they need to know so that when I'm talking to them every week, then they have a really good foundation. I'm not giving them the bare bones basics. That's a waste of my time. They can absorb that through recorded videos. And so we've basically created a course, a coaching program. We've got a mastermind now, and We actually have a done for you program where investors can join the coaching, and then we actually have the front end lead gen where leads come in, and literally come in for them. So our cold callers are dialing and then generating leads from them. And then if they pass on deals that they're not going to pursue, they can actually put them into our lead assistance program where our team will then jump in, try and negotiate those deals and monetize them by either buying them or wholesaling them, and they get financial benefit from turning those leads in too. So there's really front end to
Mhm.
back end, we've got it all, and it's just kind of whatever they want to do, they can do, and we fill in the gap. So pretty cool. And we partner with our students as well. So it's a labor of love, but it's a really good group of people, very
Yeah,
committed, serious investors. Yeah.
that's right. Hey, Mario, loving this conversation, but also want to be mindful of your time.
Sure.
So would like
This is
to
fun.
move on to the final round of questions. Are you ready?
Bring it.
All right. So the first one, which is the one book that had the most impact on your life or on your business?
I'm going to give you two books. Number one, the Bible, because it's
Yeah.
both business and personal. And then Traction. Traction opened up
Yeah.
my eyes on how to operate a business, and it's a system. And it's really helped us, implement real systems in our business. And I also worked with an implementer who helped put it into my business. So I can't take all the credit, but just opening my eyes to that structure for our business was very beneficial.
Yeah. Love that book too by Gino Wickman. Yep.
Yep, absolutely.
Great. All right. What are your main source of information to learn and grow?
Yeah, I think, podcasts, I'm in multiple masterminds for different things. So, I've been in real estate masterminds. That's great. I'm in kind of a
Any
more of a
specific
general.
names you'd like to suggest to our listeners?
Yeah, legacy boardroom is one, and that was for it's general real estate, a lot of commercial real estate guys in that, but also some single family and builders and things like that. I tend to try and stay out of mobile home park type groups because if I'm
You
talking to
already
you
know.
about something, yeah, we're talking about the same thing. There's nothing really to talk about that's interesting.
Yeah.
I mean, I go to some of the conferences and everything. If I get a chance to speak at one or something like that, I'll definitely go. But I like to expose myself to other industries. So one of the masterminds that I'm in is Vistage, which there's a couple. YPO another one, where it's really industry agnostic, but there's certain level of um, success that these entrepreneurs have to have proven to be in this group. And so I'm sitting with 15 very serious entrepreneurs in all different industries, and I'm gaining a lot of knowledge from areas of business that I'm not familiar with. And often they're much larger companies than mine, and I've gotten a lot of value out of that as well. But so masterminds, a lot of podcasts. Yeah, I'd say those are probably the two.
Okay. Which is the one habit or routine that has been crucial to your success?
Yeah, let me jump back one more on the information gathering. In the beginning, when I got into business, I always tried to do everything myself and learn everything myself. So, reading books, podcasts, YouTube, all that kind of stuff, right? And figure out how to do it myself. Where I would say a life lesson that has changed the way I do business is now when I want to learn something, I will often hire someone, consultant, whatever, to come in and help us implement it faster because yes, you spend money, but you get the results faster and you're basically downloading their experience into your
Yeah.
business. And so even with the marketing side, like we just hired another consulting group to help us do a new type of marketing strategy. And it's just um, that is a life hack. As soon as you can start to afford to hire people to come in and implement things in your business, it's worth it. You'll save years of time trying to figure things out. What was your next question?
Which is the one habit or routine that has been crucial to your success?
Yeah, I don't know if this really qualifies for a habit or routine, but maybe it does. I've seen a lot of people over the years start businesses, and the most businesses fail. And the reason that a lot of people fail in business or don't really get maybe just don't ever get traction is they ride the emotional roller coaster. All right. We've all experienced this. You have great days and you have horrible days. And when you ride that roller coaster and your work follows your emotions, you will have very productive days. And then you will have days that you do nothing because you're just like, I had a really bad day yesterday, and they're like recovering, right? And I think one of my superpowers is even if I have a really crappy day, I'll end the day, I'll go to sleep, I'll wake back up, and I'm like, you know what? Starting over. And I just reset. No matter how I feel, I still do the work and the things that are necessary to get the results, regardless of how I feel. And I think if people stayed consistent and focused on the work that needs to get done, regardless of their feelings and how it feels that day, they would be so much further along. It's when you stop, you kill momentum, even if it's for a day or two. You kill momentum and you have to ramp it up again, especially if you're in any sort of marketing and sales. Your business just got pushed back weeks, if not months. And so it's just the consistency, regardless of how I feel.
I can't agree more on that. I also believe the same thing. You got to stay disciplined, regardless of what happens.
Yes,
It'd be a good day, bad day. You got to do what you got to do.
exactly.
Yeah. All right. Mario, final question.
Bring it.
How can Decoding Cash Flow listeners get in touch with you?
Yeah, I mean, if you're looking to be an active investor in the mobile home park space, go to getrealcashflow.com. That's the education company. I can help you buy your first mobile home park. Or if you already have some, we got a bunch of clients that already own them, but they want to be able to scale. And then if you're more of a passive investor, you just want to own this stuff, whether it's mobile home parks, self-storage, small bay light industrial, or RV parks, just go to equitygrowth.net. And love to partner with you and do some deals together. This has been a lot of fun, Ted. And I really appreciate you having me on. I think you got a great show here, and I'm sure your listeners get a ton of value from it. So thanks again.
Yep. Thanks for being on the show. I'm pretty much sure they got a lot of golden nuggets out of this podcast.
That's the goal.
And they will act on it, I'm sure. All right. Thanks a lot, Mario. We'll stay in touch.
Thank you.
Have a nice day.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.